$118. SEZL fell almost 34% in one session, wiping out about $2 billion in value. And get this, the company beat earnings and raised guidance that same day. What's up, guys? Coach B here. Welcome to the breakdown. Today it's SEZL, ticker SEZL, and this one's the perfect lesson in a trap that catches even good traders, a beat and a raise that still gets crushed. Quick reminder up front, this is education, not financial advice. I'm not telling you to buy or sell anything here. Do your own research. Let's look at the chart first. SEZL ran hard this summer, all the way up near its 52-week high of $195.71. That kind of run gets you noticed, and not always in a good way. Oppenheimer and Keefe Bruyette both downgraded it, warning the valuation had run ahead of itself. SEZL reported second quarter results Thursday, August 6th, after the close, closing that session at $178.53. Friday, it gapped down to open at $132.36, fell as low as $114.16 intraday, and closed at $118.02. That's down 33.9%. Its worst day in a year, on a day the company technically had good news. And I mean genuinely good news. Revenue came in at $149.7 million, up 51.7% year over year, comfortably ahead of the roughly 136 million analysts were modeling. That's a real beat. Management didn't just meet the quarter, they raised full year guidance on top of it. Beat the number, raised the outlook. Read only the headline, and this looks like a stock that should have gone up. So why did it fall a third in a day? This is the part I actually want you to take away because it shows up over and over with these high growth names. The market doesn't just price the level of growth, it prices the rate of growth, whether it's speeding up or slowing down. Think of it like a car. Level is your speed. Rate of growth is whether you're still on the gas or you just let off it. A stock priced for perfection near its highs needs the pedal to stay down. The second management signals the acceleration is fading, the market re-rates the whole thing lower even while the car is still moving forward fast. Here's what actually spooked this call. Management guided second half revenue growth to slow to around 30%, down hard from over 50% growth in the first half of the year. They also flagged that revenue yield, roughly how much revenue SEZL keeps per dollar of merchandise volume, is normalizing toward about 11.4%. A structural headwind as buy, now pay later matures. And they said the newer stuff, SEZL Cash and SEZL Send, isn't likely to move the financial needle anytime soon. Put it together and you get a stock priced like a 50% grower that just told the market it's becoming a 30% grower. On a stock like this, growth investors aren't really paying for $149.7 million of quarterly revenue. They're paying for what that number turns into a few years out. Knock 20 points off the expected growth rate, and you don't just knock 20% off the stock. You knock down the multiple investors will pay for every dollar of that growth. That's how you lose a third of the value on a day revenue actually grew 52%. Now let's pull up the options chain and see what the market is pricing from here. I'm looking at the September 18th expiration, 39 days out. With the stock at $118, the at the money strike is $120. The 120 call is bid $11.20, asked $13.50, implied volatility around 79.5%. The 120 put is bid $11.70, asked $15 flat, implied volatility right around 79.7%. Split the mid on both legs, and that straddle runs about $25.70 against a 118 stock, pricing a move of roughly 22% either direction by September 18th. Pay the ask on both legs, and it's $28.50, north of 24% of the stock. A couple more things off that chain worth knowing. On this September expiration, the puts are actually busier than the calls in both volume and open interest, so even after a drop this size, plenty of traders are still paying up for downside protection rather than betting on a clean bounce. Short interest is heavy too, around 23% of the float, so you got real two-way tension in this name, some pressing the downside, some positioned for a squeeze back up. So how would I think about this by time frame? Day trading it, that 114.16 low from Friday is the level everyone's watching intraday. Swinging it, 120 is the new pivot. It's literally where the options chain centered itself. And if you're thinking like an investor, The real answer doesn't land until next quarter when we find out whether that 30% guide was conservative or the new normal. And here's the honest downside case. If second half growth actually prints at or below that 30% guide and revenue yield keeps drifting toward 11.4%, this stock can keep derating even while the underlying business keeps growing. With implied volatility sitting near 80%, that straddle I just showed you isn't cheap insurance either. It's the market telling you it genuinely doesn't know which way this settles. So that's SEZL, a revenue beat, a guidance raise, and still a 33.9% crater in one session because the market wasn't grading the quarter that already happened. It was grading whether the growth rate holds up from here. Same reminder, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research. Subscribe, and I'll break down the next name on the board, and drop your questions in the comments. Good luck in the markets, no matter what stock you're into.